Yeah, okay. Thanks.
Well, comrades, I'm glad to see that, we're here to have another quite illuminating discussion, I think. In the past weeks and months, we've seen a huge transition in our national and international economies, moving from what appeared as cheap money, of course, not cheap money for working people, but for the big corporate bodies, and then followed by rising inflation in a way that was what we could have assumed. And yet we've had quite a low level of inflation for a while, and now we've had exactly the opposite. And of course, the working class is held to blame, and we are fighting back. Now, what we do need as we enter into an unprecedented time of struggle is to know, the general laws of capitalism and how this is working. And what we've seen in the past few weeks is a precipitous fall of banks, with one bank after the other declaring itself in crisis, and rapid interventions, even working through the weekends to make sure that there's not one crisis or the other, leading to a complete collapse of the international credit system. And we're very lucky today to have Michael Roberts giving his ideas and analysis, and I'm sure quite revealing slides, on these issues. And we look forward to hearing you, Michael, and we look forward to a really stimulating discussion. So please come in.
Well, thank you, David, and thank everybody for inviting me. Apologies for failing to turn up online 2 weeks ago, but hopefully we can renew the discussion you had last time on the banking crisis, and widen out the discussion to the general state of the world economy and the implications of the banking crisis and the general situation for the world economy at the moment as we go into the summer of 2023. I've just put on the chat a place to get hold of the slides I'm now going to show you, so you can look at them afterwards if you can't follow them or I go too quickly. Both of those things are very likely. So let me first of all share the screen so that we can go through the ones I've got here. Make sure I get the right one. There we go. Okay. Right, obvious title. So we're doing the banking crisis, but I want to widen it out to discuss the world economy in general. But let's remind ourselves what happened back at more or less at the beginning of March, about a month or so ago, when the Silicon Valley Bank, SVB, was announced it was going bust. This was not a small bank. It specialized in the tech sector. It was actually the 16th largest in the US. And its downfall and collapse was the second biggest collapse of a bank in US financial history. So it was not an unimportant item that took place back a month or so ago. And the result of that was that the collapse of this bank had implications for other banks. And a cryptocurrency bank also collapsed called Signature, and another bank called First Republic, which another California bank. All these banks specialized in tech and cryptocurrency, also got into serious trouble and had to be provided with funds from 6 very large banks, the very big banks around, to keep it going. But what we found out as a result of this banking collapse, and if you look at the graph on the right-hand side, we find that loads of banks in the US have large amounts of investments in securities, mainly in government bonds, would you believe, which if they sold today those securities in order to meet obligations, they will be down by something like $620 billion, about nearly 3% of US GDP. So you can imagine the hit to the US economy. All these banks had to sell these assets that they've got in their hands. Why would they have to sell them? Well, in the case of SVB, they had to sell them because there was a massive run on deposits from the bank. they call that a bank run. So the depositors who had put all their money in SVB, mainly tech companies and very rich individuals, suddenly decided that they didn't want to keep their money in SVB. Why? Because SVB announced that there was a flow of money going out of their deposits, and they couldn't actually meet it with the cash that they had available because they'd invested it all in securities to make more money. As a result, they were in a position where they would have to sell a large amount of bonds in order to meet the cash withdrawal demands being made by various companies. Why were companies withdrawing their money? Mainly because they were starting to lose money themselves. A lot of these companies were startup companies. You know what that means? If you 5 or 6 of you clever whiz kids get together, some venture capitalist gives you a load of money to go and come up with a brilliant new algorithm or something, and you start doing that, then you find that you're not getting anywhere, you're not making any profit, you're burning cash, and also the venture capital company is finding it's not making any profits about all the loans it's making. The situation is changing, and one of the big problems was that the cost of borrowing in order to do this was rising, which I'll of course come to next. So there was this run on the banks, starting with SVB and elsewhere. And you can see, if you look on the right-hand side of this particular graph, you can see that whereas deposits had been increasing largely since something like 25% increase during 2020, 2021, lots of money cash going in, a lot of it from government money to subsidize companies and so on when they were during the COVID lockdowns. Suddenly that's reversed, and you can see on the right-hand side a big drop in the amount of deposits going into banks, particularly small banks. In fact, something like 500 to 600 billion has disappeared, and that's particularly since the Federal Reserve started raising rates about the middle of last year. And that's a record decline in money coming out of banks. So there's a real pressure, particularly on the smaller banks, to survive if people take their money out of the bank. And that contagion, that worry that there was going to be a series of bank runs, didn't just stay in the United States, it spread across into Europe, where 167-year-old Swiss international bank, Credit Suisse, was forced into liquidation and a takeover by the other main bank in Switzerland, eventually with the Swiss government insisting on a forced marriage. And they did that because Credit Suisse had been in serious trouble for many years, losing quite a lot of money. And suddenly with the situation in the US taking place, a lot of depositors were taking their money out of Credit Suisse as well. So there was a serious danger that Credit Suisse would go bust and people lose their money. So they were forced into a merger of that bank into one huge bank that UBS now controls in Switzerland. And there was rumors that Germany's largest bank, Deutsche Bank, was also going to get into trouble for similar reasons. That so far hasn't materialized, but you can see that generally the contagion had spread, as the graph shows left on the right-hand side. The fall in the stock price for Deutsche Bank is an indication of what was happening to European banks as well. So a lot of banks, worried that people will start taking money out of their deposits, taking it out of the bank, looked to raise funds in order to bolster their situation. Because remember that a lot of the assets that they were holding, they'd taken the cash from depositors and invested them in securities, which were losing money now as interest rates rose. So they were looking for ways in which they could cover any real danger of a run on their own banks. So the Fed, the Reserve in the US, set up a lot of facilities for these banks to borrow money, and you can see this graph shows how much the borrowing rocketed in the last month to cover possible outflows and prepare for more. Just under 500 billion has been borrowed by the Fed, evenly between the large and the small banks. Although relative to their size, the small banks have obviously borrowed much more. And a lot of that money has disappeared anyway. Something like 500 billion is left in the last 3 weeks from the banks. They've covered themselves by borrowing money, so there hasn't been any more busts yet. The Fed has supplied them with those funds. But where's that money gone? It's gone into other things called money market funds, which are basically not banks. What you do is you give the money to a money market fund manager who pays a better interest than the bank, and that money market fund manager then invests in very short-term government bills, which gives it a slight margin of profit. So that's where, but money market funds are not banks. They don't provide you with a checking service. You can't get loans from them. They're nothing. They're just an investment fund. So that's where a lot of deposits have gone in the last 3 weeks. And one of the reasons why they switched there is because a lot of the depositors are not covered by government deposit insurance court. So you see in the UK, for example, if you put up to 80,000 in a bank, you won't lose your money. The government will guarantee that you get your £80,000 back if the bank goes bust. In the US, the level is much higher, $250,000. But a lot of these depositors were very rich people or companies who have got a lot more than $250,000 in these smaller banks. And as a result, they were in serious risk of losing all their money in, unless they were going to be bailed out by the government, and there was a change of policy. And the danger is that this crisis is not over, because although the banks so far have now avoided any further busts, they have a large amount of investments and assets and loans into the property market in the US, particularly commercial real estate. You can see on the right here that the loan book of the small banks is way, way higher than large banks. A lot of these small banks have invested in local property schemes and development schemes, which they hope will make up a lot of money, and they're using deposited cash, and they're borrowing to do so as well. That was fine when they could borrow with low interest rates and when the real estate market was booming, but the two things have reversed in the last 6 to 9 months as a result of the Federal Reserve increasing interest rates. Interest rates have gone up, so we've seen the property market collapse or go backwards in the US, and at the same time, the cost of borrowing for the banks has accelerated from borrowing as a share of bank reserves accelerating. And the cost of fund and financing that has also shot up. One of the other factors that comes out of this banking crisis was the complete inability of government regulators to see this coming. Regulation totally failed, and that's the so-called policy tool for ensuring that busts don't happen, totally failed to see that banks like SVB were getting into trouble. They overinvested, they didn't have enough cash. Apparently regulators didn't see this. Worse than that, the actual officers of Silicon Valley Bank had seen this coming, and so they paid themselves huge bonuses before the bank went bust. And they also got the bank to give them huge loans to the tune of $200 million plus. The senior officers, manager, and shareholders got loans just before the bank went bust. What do the regulators do about that? Nothing. What has been said about that since it's been found out? Nothing. So regulation again failed. As the chair of the international banking regulator, the leading international bank regulator, said, the only way to entirely prevent a bank run will be to require banks to keep all of their deposits in highly liquid assets. But then you wouldn't have any banks. That's correct. Under capitalism, banks are there to make money, not to provide a service, a public service. They're to make money. So if they have to pay you an interest rate, say, of 1%, they need to look to make an investment which will give them 2% or 3% and so on. So they don't just leave the money in the bank so that you can get it later on. They invest it in other things, and who knows what might happen. And the regulators clearly don't know how they could have stopped that. So you could only have the avoidance of bank runs if you had non-profit banks that provide a public service, but that's not what they do. So we had this big bank run, and it's a bailout. There's argument being made in the US media that there's no bailout. The government says there's no bailout. It's all being dealt with by the banks themselves. That's not true, because the Federal Deposit Insurance Corporation is responsible for making sure banks don't go bust, and they have provided a lot of extra loans to various banks, in particular the bank that's taken over SVB, something like $35 billion in loan, another $70 billion in credit line to help this new bank run the remaining assets of SVB and keep it going. So it will cost something like the US taxpayer, something like $20 billion at the moment that the Deposit Insurance Fund has handed out. So this is a bailout. It's not at the same level as the global financial crash of 2008-9, but it's an indication. What I would say is that under capitalism, finance remains completely unstable. Bank runs are more than likely if situations change because banks take risks in order to make money. Regulators can't regulate, and in the end, the public sector has to bail out these banks to ensure that they survive. As Marx explained, capitalism is a money or a monetary economy. Production is not for direct consumption at the point of use. It's for sale on the market in the exchange for money. Money is therefore necessary to purchase commodities. And money and commodities are not the same thing. So the circulation of money and commodities is inherently subject to breakdown, because if I sell something and I get money for it, but I don't then go and buy something else, I hold on to it, I hoard it for whatever reason, or I'm concerned about doing so, then the person who wants to sell me something for that money cannot do so. But there's a danger all the time that the whole process of circulation will break down. And that can certainly happen and lead to a crash, whether it's in the banking sector or in the financial sector in general. But the underlying cause of such a breakdown would be the fact that no longer is it possible for the productive sectors of the economy, the capitalist sector, to make a sufficient amount of profit that they're prepared to increase investment, sustain existing investment, and sustain existing production. So when tech company customers at SBB began to lose profits and were suffering a loss of funding from their venture capitalist lenders, and they could see that falling, that's why they felt they had to take their cash out. They had to spend their cash because they needed to pay wages and meet their own obligations. This destroyed the bank's liquidity and forced it into a fire sale of its own assets. But why did that happen? It happened because interest rates were rising, because the Fed has increased the cost of borrowing, and because profitability of the productive sector was falling. The two scissors of a slump were coming together, and that's the underlying cause of this banking crisis. As a result of this, banks are now really tightened up on what they're prepared to lend to companies in the productive sectors. So that's increasing the problem down the road. Not only do we have danger of banks facing further losses in the real estate sector, but they're also not lending now to the productive sectors of the economy. They're demanding higher interest rates, or they are demanding higher credit standards. The graph on the left shows the move up in credit standards. That means that you can't just borrow at zero interest rate or borrow 100% of what you need. You can only borrow, say, 30%, and it's going to cost you 5% interest. So on, it's much tighter and tighter. And that means that the productive sectors of the economy, particularly small companies, are going to find it more difficult. And why are interest rates rising? Well, as David said at the beginning, we've seen a complete transformation from the low interest rate economies we had before COVID during the second decade of this 21st century, accompanied by very low inflation on the whole, something around 1 to 2% in the advanced capitalist countries, and only maybe 3 or 4% in the rest of the world on average. But we've seen a dramatic change in the level of inflation rates in the major economies since COVID and afterwards. And so inflation now, this is a measure on the left, this graph of core inflation rates. That means taking out the food and energy, which we're seeing huge rises in prices even more, and just looking at the rest of commodities and products and see how much those prices have increased or what rate they're increasing. And on average, they're increasing between 4 and 6% at the moment. So even if food and energy drops back and there's no inflation anymore in food and energy, we appear to have an inflation rate which is now at least twice, if not 3 times as higher than it was before the COVID pandemic. So what's the answer of the monetary authorities in the major economies? The answer is that they want to drive down the demand for goods, because they consider the reason for price rises is because demand is out of line with supply, and the reason the demand is out of line with supply is because either workers are getting too much wages or there's too much spending. Not that there's too little supply. That isn't really in their minds. They see it as a question of trying to get demand down into a better balance with supply. It's demand that has to be reduced. And to do that, if you raise interest rates, you reduce the ability for banks and anybody else to borrow, lend, then you can squeeze through the monetary policy, the economy, and so the productive sectors are squeezed by their inability to spend on investment or on production or on maintaining wages as they are. So basically, the Federal Reserve and other central banks are driving down aggregate demand to try and meet supply, but aggregate supply is also slowing. So the more they drive down aggregate demand, the more effect they're having on aggregate supply, and it's a vicious circle. And what will happen is, if the Federal Reserve and the other central banks continue to hike interest rates, as they have done over the last 6 to 9 months, that they will drive the economy into recession in the US and elsewhere, as I'll show a little bit later. And in fact, the US Federal Reserve now accepts that a recession is unavoidable. In its last meeting, just last month, it said that there now would be a mild recession in the US economy this year. This is the first time they've admitted that a recession is certain. What do we mean? They mean by that in this quarter that we're in now, April to the end of June, and the next quarter, June to the end of September, probably the US economy will have no growth or negative growth. It will be contracting. So that constitutes, in economists' technical terms, 2 consecutive quarters of a contraction means a recession. So although they expect the economy to pick up towards the end of the year, they're now admitting, which they didn't admit before, and have never admitted in a public statement before, that the US is now entering a recession. The right-hand graph is a measure of how much manufacturing activity is going on in the US economy. This is measured in by surveys and so on. And you can see that it says anything under 50 means contraction. And anything at the level which the current measure is, which is 46.3, as you see on the right there, anything at that level has always meant a recession. The grey bits in that graph are the points of when we've had slumps under capitalism. By the way, do you know how many slumps we've had under capitalism? An awful lot since 1950s. And the last one, of course, being the COVID slump, 2020. But whenever this measure of manufacturing activity in the US falls down to below 50, and certainly down to 46, if it is now, there has always been. So that's an indication that the recession is imminent and unavoidable. But I would argue the much more important factor from a Marxist point of view, from the understanding of labour, is what is going to happen to corporate profits. Now, but since COVID, there's been a massive increase in corporate profits in the US and elsewhere, both in the US and globally. You can see, if you look at this graph, that during and afterwards during COVID, corporate profits in the US are rising at nearly 70% year on year at a certain point. And global profits, has gone off the scale there because I had to reduce the scale, were rising at 50%. That's the result after the slump. The period afterwards, it's seen a massive increase in corporate profits. Prices rise. Corporations have been taking advantage to increase their profit market, increase profits. They've also been subsidized heavily by governments to get out of the economic lockdown that took place during the pandemic. So we've seen a big increase in corporate profits, but now things have changed sharply. It's not always recognized, but you can see on the left-hand side that US corporate profits have now gone negative. They're falling. They're not just slowing down, they're actually negative in the last quarter that we have, and we don't even have the first quarter of this year to see. And my measure of global corporate profits, which is on the right-hand side, which is that covers the 5 major economies in the world, you can also see that's down to just under, well, it's down to 0.5. It's nearly a negative as well. Not quite there yet, but soon will be. As a result of the slowdown that's taking place in growth of sales, and economy increasing costs caused by rising raw material costs, caused by slowing productivity growth, so the capitalist companies are not able to compensate for any sort of rising production costs except by hiking prices, which they're no longer being able to do. So corporate profits are in the downturn. When that happens, as night follows day, then investment will collapse, production will go down, unemployment will then start rising. It's always a factor afterwards, and so we will enter a recession. Recession in the US is now admitted.
a recession in certain parts of Central Europe, like Germany, and of course in the UK is already here. UK being the poor sick man of Europe, is already in recession and will continue to dive during this year. At the same time, this will be expressed in the rise of companies going bust. We mentioned before that about 20% of companies in the major economies are what we call zombie companies. They're companies that hardly make any profit. They make enough profit in order to pay the wages of the workers they've got and to meet, to some extent, the cost of the borrowing they've made. And if they can't meet that, then they borrow more money and make the situation worse for themselves. But they've been able to survive because interest rates have been so low and the banks have been prepared to lend them huge amounts of money at very low interest rates. So these zombie companies have survived. And it's important to note that when we read in the papers about the huge profits made by the oil companies, generally the energy companies, by the big tech and social media companies, the massive billions that they're making every year, this is a minority part of the whole of the corporate sector in the US and the major economies. The stock market in the US has been going up for a period of time in the last 3 or 4 months. But if you look at the overall picture, the stock market is concentrated, growth of the stock market, the rise in prices is concentrated in a very few companies, no 10 or 20. The vast majority of companies have not been making good profits and their stock prices aren't rising. And in particular, in the case of the zombie companies, they're seriously in danger of going bust. And here's an indication that the bust rate is already beginning to rise before we've got into this year. It's now at the highest level we've seen for many a year in the US alone. And so, in my view, a global recession is imminent, and it's not just my view. I've seen that the Fed agrees about the US, but the World Bank has issued a report in which they say that the global economy, speed limit, they call it, the maximum rate in which it can grow over the rest of this decade is set to slump to a 3-decade low by 2030. In other words, they see growth rates over the rest of this decade on all the major economies and ones in the peripheral economies as well, as being the lowest level of growth rate that we've seen in this century, and certainly even into the latter part of the 20th century. And the left-hand graph shows what the growth rate is likely to be over the next period. We've seen that on the average growth rate for the last 10 years in the world has been around 4%. It's going to drop to under 2% according to UNCTAD. And even in the faster growing economies of the so-called global south, to some extent, even their growth rates are dropping fast. And so the World Bank's chief economist reckons that we're heading for a lost decade in this 2020s, as it could be in the making for the global economy. For that matter, the last decade was a lost one as well. So we've had 2 in a row, if you like, an indication of where capitalism is going. And I have to say that, and it should be mentioned, that we often look at the US, the UK, the big economies of the advanced world, the capitalist world, of the imperialist economies, but we should remember the situation is way worse in the global south, as it use the shorthand of the peripheral economies. They face a huge increase in debt, which they built up in order to try and grow to some extent over the last 10, 20 years. And now the interest rates are rising very sharply. According to the latest figures, external debt payments for 91 countries will average at least 16% of government revenue this year, rising to 16.7. That's way higher than it's been previously. As you can see, the right-hand graph shows you the increase in the cost of debt payments. That means that all these poor countries' governments are having to pay debt to the imperialist world, the big multinationals and the banks, increasingly large amounts, because interest rates are rising as well, which leaves them less money to spend on public services, health, and all the things that their people need. Lower income countries are in a debt crisis, which is only going to get worse over the next year. A debt doom loop, if you like. And these debts, if you look at the graph on the left, I think it's a staggering thing to note. The countries spending more on debt than on healthcare have now increased sharply.
to 62 countries now in the world spend more on debt, the government does, the government revenues, than they spend on healthcare and education for their people. And according to the World Bank, external debt payments now are going out to, who do they go to? Well, just under 50% goes to basically banks, hedge funds, and other private companies who have lent or given loans to companies and governments in the poorer countries. 30% are to organizations like the IMF, the World Bank, and so on. Just 12% to ordinary national governments. China has now one of the biggest lenders in the world, 12%, and other governments, another 12%. But you can see something like 75% of all the money owed by the poor countries of the world either goes to hedge funds, banks, and multinationals, or to the IMF and the World Bank, who set very severe conditions on those loans that they give. Something which we discuss at another time. And I would just say that we have a new president at the IMF. Is Ajay Banga, who's taking over from David Malpass. David Malpass was a Trump nominee who was brought in, a climate change denier, who has operated in various private financial institutions before he was made the head of the World Bank. The US appears to have control over who's the head of the World Bank. He's leaving, and MasterCard chief Ajay Banga is taking over. Obviously, a man very suitable to providing support to the poorest countries of the world through investment funds from the World Bank. He's got a view which is basically one that you would imagine most financial institutions have. But a recent report showed from Oxfam that for every $1 that the IMF gives to countries, poor countries, loans to spend on public services, it's told them to cut public services by 4 times more than it's lending. That's an indication of the role in which the IMF plays. Insofar as governments are forced to go to the IMF for the World Bank funding, certainly the IMF, they end up having to make severe austerity measures in order to get the funds to keep them going. And countries now that are basically bust and cannot pay their debts include Sri Lanka, more or less Egypt, more or less Pakistan, Zambia, and a few others that slip my mind that are a similar size. We have a whole range of countries now facing their inability to meet the debt demands from the hedge funds and multinationals. I just want to finish on David Emerson's point, a question he raised with me. There's a lot of talk about we can break from the control of imperialism, we can break from the control of the dollar, which is actually like the currency symbol of imperialism, because countries like Brazil, South Africa, Russia, China, and so on, the so-called BRICS, B-R-I-C-S, this group of large, relatively large populated countries outside of the advanced capitalist world could break from the dollar and the euro and look for a new way in which to finance trade and investment and avoid the control by US imperialism. And that this is going to be the way forward. The dollar is now on the countdown to a wipeout by BRICS and others. Well, I have a lot of doubts about that at this stage. Nearly 60% of global reserves are still in US dollars, 20% in the euro, so that's 2 big imperialist currencies dominating reserves, and 90% of world trade is mainly in dollars. So we don't really see an end to the power of the US dollar and the euro to some extent, particularly the US dollar. Yes, there has been an expansion of trade, financial flows and reserves in other currencies in the last few years. But just to give you an example of how far that's got, world trade, 2% of world trade, or just under 3% of world trade, just 2 years ago, was in Chinese renminbi. Now, in 2023, currently, it's just over 4%. So, yes, Chinese renminbi has increased its share of world trade, but it's tiny, tiny compared to the role that the dollar plays in oil and other commodities and all kinds of production. So I don't see
a very quick development of an alternative power to the role of imperialism in the major economies. Yes, we're having fragmentation. Measures have shown by the World Trade Organization that there's an increasingly less trade and investment of financial flows in the dollar and the euro. The left-hand graph here shows the blue line, shows the total amount going to the euro and the dollar in trade and investment. And if you see that, it's coming down, but it's coming down from, I think, just over 98% to 91%. So if you can say that that's the end of the combination of the dollar and the euro, I think you're pushing your luck here. The right-hand scale and the red line shows how much is being traded in other currencies. We're nearly up to 10%. But that's all. That's how far it's gone in that period of time, which is presented below there. So there is some measure of decoupling or fragmentation of currency control by the dollar, but it's fairly limited. And perhaps you should say that it's not a good idea. Wouldn't it be better to have one international currency which everybody supports and provides equality to carry out trade between different countries? Of course, we don't have that. But if you start having lots of different currencies, there's lots more exchange costs are built in and other transfer costs, which will make it very difficult to expand trade and export so simply. That will actually lose some extent GDP growth or improvements in resources as a result. Finally, this is the great hope of the BRICS, the so-called, of certain countries that argue that there'll be a different bank that can replace the IMF, replace the World Bank, a development bank which will be controlled by the BRICS, not by the US and not by Europe. This is called the New Development Bank, was set up in 2015, and quote, at mobilizing resources for infrastructure and sustainable development projects in the BRICS and in other emerging markets. And you can see that the countries which are controlling the voting shares of this particular bank, basically they are spread between the five BRICS evenly, although the actual amount of resources put in by these countries is different. But it's a 20% share. Is this going to supplant the position of the US and the European powers, the imperialist powers, in controlling finance and development? I think not. And the quote that I've given the right-hand corner, I think sums up the position at the moment. This is a blind hope. If people are expecting that these big populous countries are going to be able to combine together, not only to defeat imperialism on the economic front and establish a completely different multipolar bloc that can rival imperialism within the period of the next few years, then I think that is a very optimistic position to take. So in sum, we have a situation where capitalism continues to be in crisis. We have the new form of its crisis taking the form of banking crisis, caused by the fact that the capitalist monetary authorities in the West are being forced to raise interest rates sharply because of inflation, or at least they think that's the solution. In so doing, they're driving these economies into recession. They were already heading in that direction, in my view, as profits were beginning to fall, but now they're increasing the likelihood of that. And at the same time, there is no escape for the rest of the world from this crisis. If the US goes into slump, if Europe goes into slump, then the rest of the world will be facing a slump too, and they'll be facing higher interest rates, increasing debt liabilities, which they won't be able to meet. And so as we go through into 2023 and beyond, we're entering a very difficult period for world capitalism and imperialism. And there's going to be no way out by building a new bank that supposedly will rival the.
Well, Michael, thanks for a tremendous presentation with many facts and much interpretation and a marvelous, conclusion, to that presentation. I would now invite people to raise their hands electronically so we can see you. And any new people who have not participated previously, I can see one or two. Please, raise your hand and you'll be given an opportunity to speak. And the only limit on discussion is that of time. Just one general, very broad point as a question, Michael. I wondered if, in the past, we've seen low interest rates largely because after, 2008, I think we felt that we were in a period of deflation. In other words, are we entering now into a period of stagflation? If it is that, then what are the characteristics? I think you've pointed to some of them, but not now, but when you can come in on that. Jack, you're welcome to come in, and then Leslie.
No, thank you. Thank you for the presentation, Michael. Very informative. So I have two questions. The first one is related to what one of the questions David just asked, which is, why was inflation so low in the decade prior to the pandemic? And could it have had something to do with expansion on the supply side through especially production in East Asia? And the second question is related to, there was an article in the Financial Times, their big read this past Thursday, which was titled The Beijing Club. It was about, the basic theme was that China has paralyzed the IMF's ability to renegotiate sovereign debt, and that the problems with the sovereign debt in Zambia, which you mentioned, and elsewhere, are because China, as an alternative lender, now has the power essentially to block the IMF as an alternative source, and China is playing hardball in its renegotiations and so on. Apparently, the hardball is that China's demanding that the IMF also be held to the same standards that they're implying to other people. So I'm going to stop with those two.
Okay, some interesting questions there, Jack. Leslie, come in.
Okay, thanks. Thanks for that, Michael, as ever. Really informative, tons of information packed in there. And obviously the economic prospects are very grim. I just want to raise a question and make a comment. I think in the last discussion, I wasn't able to be there, but listening to the recording, it was raised about this issue of growth that's been raised, in a lot of the climate change and kind of green with a small g movements, and I think that was raised in the last discussion, because I think as socialists, what we need to do is to not just discuss that, capitalist decline, but what socialists could envisage as growth, what we see as growth, because there is sections in the climate change movement, are proposing this just anti-growth. And I think that as socialists, we need to have an alternative to that, because obviously we're not just in favour of the usual capitalist growth, destruction of production and the whole cycle. We're in favour of something else, because I think when you're either in the global south and you're starving and you can't borrow money, you can't develop your economy, being against growth doesn't necessarily appeal. And also, here, for instance, in the UK, people have seen a dramatic drop in their standards of living. And of course, there's political and industrial consequences of that. And we've seen that in the strike movements. And, just on the nurses, for instance, I mean, food inflation is over 17% in the UK now. And, it's great to see that there's a whole section of nurses who've completely overthrown their leadership's recommendations and, want to take strike action. And it's very significant that it's actually the Royal College of Nurses who are kind of a dual thing between a professional organisation and a union, and the union leadership recommended that pay deal, and that the Royal College of Nurses, having had their first strikes in their history, have actually voted to completely reject that. And a couple of us are on some WhatsApps with various nurse activists, and people are absolutely furious. And there's people leaving some of the Unison, for instance, because the leadership has really pushed, and because of the vote that's going to get, for accepting this rotten pay deal. There's a massive switchover of unions. Now, obviously, the end result of that is people are going to have to fight the union bureaucracy in any way possible. But obviously, these, other consequences flow out of this situation with, high inflation and the economy, grinding to a halt. So, although the economic prospects look grim, I think the industrial prospects are certainly still there, and obviously they've been out in the junior doctors' picket lines, etc., who are saying they won't go to the negotiating table if they're told to drop the 35% catch up over the last decade. Thanks.
Thanks, Leslie. Ed, I'll take you, and then I'm going to give preference, if I could, to Newton, who has not been able to attend our discussions, previously. Let him come in before you, Finbar, and then Matthew, if that's okay. Ed, go ahead.
Hello, can you hear me?
Yeah, loud and clear.
Okay. Thank you, Michael, for a very, very useful and informative presentation. My only disappointment is that the acoustics have been quite bad in this meeting, and particularly that was the case, Michael, when you were speaking. So I don't think I gathered everything, but what I did gather was, of course, full of insight and wisdom, and I'm very grateful for it. Just a couple of small attempts, David, to answer questions that have already been raised. Jack, I thought a very interesting question. Why did inflation remain so low after 2008, even though the banks were bailed out with an enormous amount of money? And I think that my contribution to answering that question, which is probably complicated and Michael can add something to it, is that probably, first of all, the banks themselves kept a lot of the money rather than giving it out into the economy. And so although they were bailed out, there wasn't that effect on demand within the world economy that you could expect from a big influx of money. The other angle to it is that during that period, the increase of production in Asia, particularly in China, actually kept flooding the world with very low cost goods. And then the transfer from as wages rose in China, the transfer to other countries of Asia, like Malaysia, Vietnam, and so on. Some of the costs of labor were kept down by that sort of increase in the rate of exploitation in some of the Asian countries that were supplying the world with some of its goods. In relation to Leslie's points, I mean, I think it's the huge gap between the capitalist concept of economic growth and the socialist economic vision is actually central to our understanding of what the workers' movement is having to do. I mean, when you look at capitalist articles in the Financial Times and so on, however informative and erudite they are, their vision is that somehow everyone has to pile out into the high street to buy more clothes, to buy more fancy goods, to buy bigger cars, to fill the world with more and more consumer goods. And the socialist approach to economic growth, this is where jobs can be created, but we're talking about efficient public transport systems that actually bring down the need for the use of carbon and for the use of human labor, health services, agriculture that doesn't rape the soil, so that we're not continually in this cycle of trying to find new ways of feeding humankind by encroaching more and more on wild forests and so on. Homes for those who don't have them. I mean, these are the kind of tasks that the first stage of socialism could begin to create jobs in tackling these things. And eventually, of course, with the development of socialism comes the reduction of the working week, the reduction of working hours, and actually the need for less production, because humans have what they want in terms of goods and can use their time for other things, for cultural things that don't necessarily involve building huge amounts of stuff, which is the only vision that capitalists have for developing their economy. That's it.
Okay, thanks. Some really good points there. Newton, would you like to come in? It'd be great to see your face if you had enough bandwidth. Otherwise, please hang in. Go ahead, please.
Yeah, thank you very much. Well, I have three quick questions. The first one is that to what extent is the current price increases, the current inflation, as a result of speculation on commodities in the futures market? To what extent are these the commodity traders through the
We're losing you a bit, Newton. Yeah. I'll tell you what, we registered that question. Could you see if you can get better bandwidth, and I'll ask Finn to come in now.
Okay. Oh, you can't hear me?
No, I couldn't hear you, but maybe it was my problem. Please just repeat your points and go ahead, and then it'll be Finn.
Okay. Yeah. The first question was to what extent is the current inflation as a result of speculation, by commodity traders in the futures market, the financialization of food, of energy, and all of that. But secondly was that, what is the rationale behind Andrew Bailey, the chair of the Bank of England, Christine Lagarde, they pointed out that in fact businesses are increasing prices as the central bank are increasing interest rates. And in fact, here in South Africa, the Competition Commission came out pointing out that businesses are just marking up prices, hiding behind the veil of the much publicized inflation. So despite all this, the governor of the South African Reserve Bank, Andrew Bailey, Christine Lagarde, and them, they know this. They know businesses are factoring interest rate into the prices, which means more inflation. Why is it that they just continue to raise interest rate in an attempt to fight inflation? And then finally, I missed the reason for the bank run that hit SVB Bank. Because of the sound, the acoustics, I could not hear it. Perhaps you could repeat it for me. But why is it that the SVB Bank did not utilize the discount window at the Fed? Because I'm given it's when you are in trouble that you are allowed to go to the discount window to get reserves to be able to clear your transactions. Thanks.
Newton, thanks for those very crisp questions. Finn, would you like to come in now?
Yes. Comrades, like other comrades, I want to thank Michael for a very informative opening contribution, particularly the charts that you displayed. I want to begin by just stating a propaganda victory which the capitalists enjoy. They've managed to equate freedom with economic growth. And that's unfortunately, it's a widely disseminated notion. When we talk about growth, it's not just about going into high street shops, it's about foreign direct investment. And there's a demand in countries such as Ireland, where I live, for foreign direct investment because the Irish capitalist class are too weak themselves. Sorry, comrades, my camera is jumping around there, but I'll continue.
Go ahead. Yeah, carry on. Yeah.
When Biden was here the last week, I don't know whether people looked in any detail of what he was talking about, but he was saying that if the political settlement is achieved in the north of Ireland, then American companies would flood into the country, providing jobs, meaning exploitation. But that was his argument, if you listen carefully to his argument. And he had Kennedy with him, one of the grandson of Robert Kennedy with him, whose only job being here was to introduce US multinational companies to the north of Ireland so they can exploit workers over there. And that equation of freedom with economic growth is a propaganda victory point which capitalists enjoy. And even though they talk about the West and freedom, some of the most unfree countries in the world we're supposed to accept belong to the West, such as, for example, Hungary, Saudi Arabia, India, other countries such as that. Incidentally, China is to the west of America, so even the term West is a strange terminology in itself. But it's a propaganda victory. And I want to just make a point about the recession, and maybe Michael could expand a bit more on this. There's a big spread in the Economist this week, explaining the tremendous growth and potential in the American economy. And it explains that 58% of the GDP of the G7 countries is accounted for by the US. And that includes other countries like Japan and Germany and so on. So America is way ahead in terms of its dominance of the world economy. And I want to just maybe ask something about the effect of the recession then being doubly bad because of that dominance. But another point which also emerged in that article was the proportion of the US in GDP across the world is 25%, and China is approximately 18%. What are the implications of that in terms of the competition between the US and China? And just another point, Michael mentioned that the so-called BRICS countries, Brazil, Russia, Africa, that they might present some kind of an alternative. That's absolutely impossible because they don't agree even amongst themselves in terms of perspectives. And that's something else that has to be nailed. But somehow you can escape the kind of duopoly of the US and say China, Russia, and so on, with these newer third world countries. So maybe we could spend a bit of time on that. It's also that argument that the BRICS countries represent something new. So once again, thank you very much for the opening contribution.
Thanks, Finn. Matthew, please come in.
If I manage to unmute myself. Okay, yeah, thanks to Michael for that. I think the thing is that obviously we're at a further point of crisis. I mean, I think the thing is that we're looking at really a prolonged depression is what we're living through. And obviously it goes up and down, but it is actually a depression. And we should look at it like that. The thing is, the other interesting, there's a few interesting features, I think. One, of course, is the refusal of the capitalist class to invest. It's actually, I mean, as Michael points to, fictitious capital, exactly, yes. But it's the capitalist class is stockpiling money and then seeking to play games with that money. It's refusing to invest. You can see that quite clearly in Britain, where the capitalist class refuses to invest in things like electric batteries, etc., etc. They don't want to develop manufacturing, any of that stuff. And we've also got a position now where China has been the dominant manufacturing power in the world for the last over a decade. Okay, GDP, whatever else, but in terms of what's actually produced, China is the world's largest manufacturer, which is one of the reasons why Americans want to go to war with China. It's also the effect of what they've done in terms of quantitative easing, which is to create a huge amounts of money, and as Ed said, to basically give it to themselves, and in that way hold up the banks. I mean, the thing is that the interesting thing I think about the banks at the moment is that, one, they're all rotten. The system is clearly rotten. And basically what they've done is pump all this money into it in an effort to keep it from actually falling apart. And two, they're all interconnected. And so they can't actually now render any given bank bankrupt or remove it or whatever else. They then have to basically hold it up and in some way transfer that to some other institution, as we've seen with Credit Suisse, as we've seen with SVB, as we've seen with Signature. Basically, these things are kept. You know, they can't, because the system is so interconnected. It can't be, bits of it can't be taken out, because the problem is the whole damn thing could just unravel, and probably would, because of the nature of that. I think that the other thing, of course, as Michael says, is regulations become purely nominal now. You know, I mean, the whole thing. Somebody described the signature, the thing with Silicon Valley Bank as banking 101, the basic textbook stuff. You know, basically because they weren't looking, so the thing went down the tube. And the guy, as I say, the guys running it made a load of money. So you have a position now where banks can make loads of money and then collapse and be bailed out, where those who manage banks can extract a load of money and nobody goes to jail, and in which regulators don't actually regulate. So I mean, the system is really up again, you know, in a very, very dire situation. The other thing I think, you know, in terms of the increase in interest rates, it's naked though, isn't it? I mean, if you look at what Jerome Powell, the world's chief banker, the chairman of the US Fed, has actually said, and Bailey, of course, others, he said, well, okay, we're going to put up interest rates because we want to hold down wages. They've said it in as many words. So, you know, obviously we've got inflation. There's inflation which is based on an increase in due to wars and whatever else. But they want the working class to pay, and they've said it nakedly. You know, they're not shy about it. You know, you guys can pay. We'll squash down your wages. We'll make you unemployed. You know, and that is what it is, and it's because of that. Obviously, that then creates this enormous issue within their own system as well. It's quite, in one way, quite ironic. But you know, the driver is obvious. I think what's said by the comrade from the South African comrade talking about speculation is also true, of course. I mean, as somebody I saw recently that somebody worked out that, of course, all the commodities houses, certainly for the food side, actually made a vast amount of money from the declaration of war in Ukraine, and they actually forced up the price of food by multiple times, and were able to make billions by so doing, and therefore actually, you know, obviously creating starvation, but vast amounts of money for themselves. So the system in those terms obviously can only be slated and said, you know, basically these people are just there for, you know, death, poverty and death. It's the only thing they've got. So in those terms, you know, we face a really serious crisis, but really the ruling class doesn't have any answers at this point. Thanks.
Thank you. I wonder if I could make some points, but please, everyone else who wants to come in, please do not feel inhibited. And Roger, just watch me if I exceed 2.5 minutes. Look, I'm trying to think in terms of, you know, big theoretical terms, and think in terms of long cycles. And what the world economy has gone through at different phases is one of accenting and developing certain technologies. In the past, it was coal. Then it was electrical, but of extreme development of globalization and communication. I don't want to even, you know, make a difference between those two. Those are similar issues.
David,
and now we're into a period where the world has been unable to break. I can see it. I'll speak a little louder. I'm sorry. I've also got, yeah. Yes, I apologize. I'm not quite sure what to do except, yeah. Okay. I was saying that, the global capitalism as struggling to end that dependence on coal and move over to new technologies. And if so, what is this? And I think what's happened in the current round of inflation, and we've not discussed, and I'll just mention it for you to respond to, is that every substantial war leads to an oil crisis. I mean, war requires, extreme use of oil, and then it also disturbs markets in a very decisive way. And I think that's one of the reasons for the, really high inflation relating to oil directly, and then to inflation generally. And we've now seen that there's a development of new coalitions worldwide in which Russia and Saudi Arabia are able to get together and push up the oil price by 5 to 7%, it seems, in the recent period. In other words, they're holding up the price of oil internationally and not allowing it, to fall to previous levels. That's in a sense a response to one of the points, which one of the comrades made. So it seems as that world capitalism cannot really break itself free from fossil fuel costs, which are built into the system, and that relates to the slow technological innovation. Because we should have already seen a substantial breakthrough in a new sector, which might be ultra cheap energy sources, which would then give capitalism the basis, the technological basis for a new upturn and new developments. In fact, it seems as though innovation in a very global sense is slackening. So all we're doing, and particularly in the IT sector, is rehash existing ideas without any particular breakthrough. That's one question. The final question, relates to many good points you made in relation to the dollar and the problem of de-dollarization. It seems that the crisis in third world currencies is relating to the ultra exploitation of workers in the third world, particularly those in the mining sector. And maybe that's one of the components of the present crisis, is that much of the crisis in the first world is being displaced into the third world, with grinding poverty coming in Zambia, and now we see in South Africa too. That's my point. Carol, please comment.
Yeah, a couple of points. One of the points that you just made, David, about the fact that there really can't be innovation because these companies basically have to save themselves. So they'll do whatever they can to prop themselves up, which basically means that they can't innovate, except in the tech sector, where they want to get rid of thousands and thousands of jobs. So we have AI. And now the tech sector, I think Google announced something like 11,000 jobs, and on top of another Amazon laying off thousands and thousands of people. And that's where they innovate, in order to be able to get rid of workers, to exploit the rest of the workers that are remain on the payroll. And I think that gets us back to the question about the bureaucrats. The trade union bureaucrats are the impediment for standing in the way of the working class organizing itself and really, creating a challenge to capitalism. And unfortunately, people like in the multipolar world, those leftists who think that their job is to build up China, to build up Russia, as some sort of alternative to American capitalism, that's what's going to save the world, because it's the United States that is the big dragon, that's the big problem. And so what we have to do is support essentially all these reactionary governments, Iran and Russia and stuff, in order to be able to bring America down a peg. And so they, I was glad that Michael put that picture, because that was the first question I was going to ask about the BRICS and how Dilma Rousseff is being, lauded as being the new president of the bank, and how this bank is going to be the challenge to American imperialism and to the dollar. And I mean, all of these made up absurd things, as if the United States still doesn't control the world economy. And I mean, essentially, if you have these other, even if you did have China run things, essentially, they're going to still be putting people into debt because they're the major lenders, especially to places like Africa. And I mean, it's like they can't think outside of the box, essentially, instead of thinking that the working class has to be the force that's going to change all of this. And I thought, I think it was Ed before when he talked about growth, is really what we want to be looking to, not to be looking towards keeping the price of oil up. And so, we have to begin to challenge. I mean, in the United States, it's clearly the bureaucrats. New York is the mayor of New York at this point is ravaging the budget on health and on education, and because he can't figure out what to do about the rats, even in New York, he's hiring more cops. So he's spending $5.5 billion more on police because clearly there's a social crisis, and the only way to deal with it is to shoot people, hire more police, put them in prison, or fight for a socialist revolution. But all of these leftists are looking for this multipolarity thing instead of looking to the working class. So they form this other layer behind the union bureaucrats who, are going up to the governor and begging for money, and they don't even think about taxing the rich. They're in New York City alone, there's 112 billionaires who pay hardly anything in taxes. And yet, as Michael kept saying, it's the working class that's paying for this crisis. The working class is continuing to pay for the crisis. And I mean, there's really no alternative except for the fact that World War III is coming, or, socialist revolution. That's it.
Okay, thanks, Carol. Do I see any indications, any further questions, contributions? Well, look, we've, passed a heavy load over to you, Michael. So maybe we should give you a chance to come back and on many of those rather varied questions. So we look forward to what you say. I'm just talking a little slowly, just in case another hand appeared, but I think it might be over to you. Michael, please come in.
Yes, well, first, sorry for the sound. I think it may well be me. My mic doesn't seem to be working too well here. I'm now getting quite close, I hope not too frightening, to the computer to see if the sound is better. Anybody can stick their finger up and say it might be a bit better. Yes, good. I think that's probably the reason. So I'll also try to speak slowly, David, and also more closely so people can hear what I've got to say. First, let me deal with Newton's point. I think it was Newton who said that he missed the SVB talk because he couldn't hear my mic properly. Why didn't SVB go and borrow some money for the Fed rather than go bust? Go to the discount window. For those who don't know what the discount window is, basically it's an overnight facility. You can contact the Fed, and if you're a company and you can ask, or a bank, you can ask, mainly a bank, you can ask, not a company, you can ask for a loan straight away overnight to cover any immediate cash problems you've got. Now, the reason the SVB did not do that was because if you go to the discount window, everybody knows. And if that was the case, that they were going to ask for billions from the Fed, it will immediately, the stigma would arise. Well, why is this small bank suddenly asking for a load of money from the Fed? That means they must be in deep trouble. So immediately the depositors would have been getting their money out. Remember, depositors don't have to go down to the bank branch and ask the teller, can they have their money now? They just go on the computer like us and press the, make one stroke and all the money's gone. Because that's the way online banking works now. It's instant, particularly with companies and rich individuals who make sure that the money can be transferred in a second. So the reason SVB didn't go at first to the Fed for any funding was that they didn't want to give the impression that they couldn't meet their obligations with depositors. In fact, they only made things worse because then they announced that they were going to sell some of their assets and try to raise some more funds. And all the depositors said, why do you want to do that for? You must be in trouble. So let's take our money out. So the result was that you got the bust and the bank run anyway. I think the other point Newton was making was that is the current inflation not just a product of a huge amount of profit markups by loads of companies around the world, taking advantage of both rising prices in food and energy and also rising interest rates and passing on all those costs to us, the consumer, the working people, by hiking up prices and also increasing the markup of profits. Well, that's certainly been part of the process that we've seen over the last year and a half. Profit markups have gone up. What do we mean by a profit markup? That's the difference between the costs that the company is paying per unit of production and the price that it's receiving for the sale of that per unit of production. That difference per unit is the markup. And so, you know, the store, like a supermarket store, will have a markup on the cost of your food. Whatever that markup percentage is what we mean by the markup. And the markups have risen on average in the US and in other countries to record levels in the last year and a half. So clearly, the inflationary spiral caused by not by increased demand from workers, but caused by all the factors we've seen, the war, the COVID lockdown and so on, has given the opportunity for companies to hike prices and not only to sustain their profit share, but to actually increase it dramatically over the last year and a half. But what I would add is, and then the other point that Newton made was that then people take advantage of this and speculate on the prices, particularly in commodities, and so actually accelerate that effect, particularly in commodity prices. And speculators and traders have been doing that as well. But what I would say now is, as we go into the second quarter of this year, that situation is now changing. Profit markups are coming down. Profits are coming down. Inflation, at least at the headline level, is coming down. Food and energy prices are coming down from where they were before. So year-on-year rates are falling. And that's an indication that the global economy is slowing down so much that prices, the corporations cannot sustain the prices they had before. And they're also now, the squeeze they're getting from interest rates can't be passed on to consumers so easily, although we still have an inflationary level that we haven't seen before. So this is the situation that changes. Are we entering a period of stagflation, David raised, in the sense that, well, what do we mean by that? We haven't had to use that word since the 1970s. It's that economies are flat, they don't grow in GDP. I'll come to what we mean by GDP in a minute. But the inflation still rises. So you've got a stagnating economy with inflation, which we had in the late 70s and early 80s. How has that got rid of then? It's got rid of by two ways. Massive slump. In 1980-82, we had two slumps in the world major economies. Manufacturing was decimated, and also interest rates were raised to extreme levels by central banks. Well, guess what? We seem to be entering something similar as we go into this year. Rising interest rates as central banks claim to be trying to control inflation and drive it down, and at the same time profits are beginning to go down. So we could be by the end of this year in a slump with interest rates still high, causing a major end to this. So you could have not so much stagflation, which will then disappear, but actually a slumpflation, where inflation stays up a little higher than it used to be because it's fed into the economy now in a certain way through various markups that we've seen, but also we have a recession in the economy. So where the days of low inflation that we saw before the COVID pandemic in the decade of the 2010s, and even in the decade of the 2000s, have gone because of the reasons which have been described. First of all, that was mainly due to two factors, which Ed has pointed out very accurately, that a lot of the money demand that was available did not go into productive sectors. It stayed in the financial and real estate sector. So we forget there was massive inflation in another sense. Stock prices and bond prices rose dramatically in those 2 decades. Real estate house prices in the major economies rose dramatically. That's where the inflation was. It wasn't in goods and services, where prices were relatively low in the increased inflation, partly because of the low costs production that was coming from abroad. Now we have a different situation where world trade has been slowed down sharply. In fact, it's been contracting to some extent. That means that the ability to pass on cheap goods into the advanced capitalist world is declining, and at the same time, no longer is it possible to expect huge amounts of money to be pumped into the economy, into the banking and real estate sector. And so any money that's around is not actually going to happen. There's monetary tightening going on. So there's a squeeze on, which means a recession, but it doesn't mean that we're going to return, in my view, to a low inflation environment. That brings me to the question of growth. Leslie raised the question, well, as socialists, surely we want to say something about the argument being presented by many people on the left who say we shouldn't be just looking about growth. Michael Roberts spends all his time talking about whether there's growth or not. That's not a way to look at it as socialists, because what do we mean by growth? Well, under capitalism, we mean by increases in gross domestic product, or GDP, but that doesn't mean the same thing as growth in things that we need, use values, as we used to call it in socialist terms. Is there an increase in use values? Not necessarily reflected in an increase in GDP. As other speakers have pointed out, there are lots of things which we don't see growth in: housing, education, health, transport, things which are really use values to us. Or growth in the amount of commodities we can get that we eat or use at reasonable prices. We don't see growth in that. We see growth in military spending. We see growth in advertising. We see growth in real estate prices. We see growth in stock markets. Many of these things are added into the GDP figures, so they do not reflect what is going on in any way in terms of what matters to working people, both in the advanced capitalist countries and internationally. But we have to counter that idea that we should dispense with growth altogether, because that would not be clear. What we need is the growth of use values, the growth of improvements to conditions for everybody in the world. And that means better public services, better food, better all the basic necessities. We need growth in that, surely, and not a cut back in that growth. And so that sometimes the degrowth people seem to suggest that all we have to do is stop production, and that will reduce climate change. Well, it certainly would. It would reduce global warming if you stop production for a period of time. And they say in some way, we don't say that the global south must reduce production, because they're obviously poor. So we need to transfer all the wealth that we've got in the global north to the global south. But how is that to be done within a capitalist economy? It will require a revolutionary change in the advanced capitalist countries and the global south in order to bring about the transfer of resources. So we need two things. We need resources production aimed at use values, and we need the transfer the reversal of the growing inequalities and poverties that exist in the world. It's not a question of degrowth, it's a question of reorganizing the growth of use values on a basis which meets the needs of the world's population. Brings me to the question then, I think, of Matthew and Finbar's point about the American dominance, which we raised earlier on. This is the big issue in the 21st century as we go into this third decade, that America's dominance is relatively weaker. We have to recognize that America is still dominant, but it is relatively weaker in its ability to control the world production, trade, and finance. The one area which is still relatively strong is in military power, and it's now looking to stop the rival powers
that it sees in
it's coming in its direction, particularly China, over the next decade or so, to ensure that they do not weaken the ability of American imperialism to dominate the world and set the agenda for places like Northern Ireland and really in the south. They've done that. They need to change that. They do.
They want to stop the ability of China
and other powers to have an influence over places like Africa and elsewhere in the world, where that will mean a tremendous
loss to imperialism, particularly US imperialism, in terms of the transfer of surplus
value, profit, income, and all the rest of it. So it must be stopped, and they have military power to do that, and they can at this stage still try to bring into their umbrella a coalition of
willing capitalist
powers
to carry out the encirclement and strangulation of anybody who opposes American imperialism.
So we have a proxy war in Ukraine, Russia, between Ukraine and Russia, and we have the build-up of conflict, both trade, economic, and military, in China, towards China, over the question of Taiwan. That's going to be the big issue of this decade. I don't know how it's going to be resolved. That brings me to perhaps the final point I could say. I've probably forgotten a few. That is the question of, can capitalism get
out of this mess and transfer itself away from its dependence, as David said, on old technologies, including fossil fuel technology, into a different
layer of new technologies, which is done in the past in cycles of new technology, create the conditions for a rise in profitability and expand the world economy on the basis of capitalism. Well, at the moment, I don't see that's going to be possible without significant reduction in the old technologies and the devaluation of the value to capitalism in that process. That means big slumps. That means doing away with a whole load of layer of companies that are no longer producing anything that can
be profitable to capital, and replacing it with new technology companies
that can be profitable. Capitalism has certain optimism. Some of them do.
Anyway, about this being possibility that they can do this. You've probably seen ChatGPT,
the new artificial intelligence and robotic things, these machine
learning
language machines, which are apparently going to be so fantastic they can dramatically increase the productivity of a shrinking workforce. And all of you that I'm looking now on the screen will no longer actually exist. You will merely be an artificial intelligence, and I will be also an artificial intelligence. There is no guarantee that what you're looking at in the next 2 or 3 years is actually a real human being, but merely an AI logarithm that is presenting these arguments. And the argument they're presenting is that this can be possible. It would be possible to dramatically raise the level of information, technology, and actual results in terms of physical production through the use of these new machines. Well, I don't see it yet, and I think that it would require a dramatic change in, as David said, in getting rid of the old technologies through a series of slumps to raise the profitability of these new technologies, because otherwise it'll be hamstrung by history, as it were, capitalism's old form. So in sum, for the immediate future, we can expect in this next year a move towards a general recession in the major economies, which means eventually a rise in unemployment, a fallback in inflation, but at the expense of a rise in unemployment in the major economies, and a continued stagnation of incomes for working people in general. Remember, in the UK, for example, the UK has not seen any rise in real incomes on the average for the average worker for the whole of this current century. This is the longest period of stagnation in real incomes in the history of capitalism, British capitalism. That's an indication of the situation in Britain, but it also applies to other countries where real incomes have been stagnating, particularly for the average worker, over the last 20 years. And I just see that we're entering a similar period ahead unless there's dramatic change. The options are a big slump or the continuation of this depressionary environment and an increasingly dangerous conflict developing between the imperialist powers and those who do want to resist the imperialist powers internationally. We're entering a period now, economically and politically, where a lot of decisive issues are going to be decided for capitalism, leaving aside the existential challenge that capitalism faces with global warming and climate change. It also faces two other major challenges: its ability to provide any resources without crises for the working people of the world, to avoid poverty and improve that situation, and to avoid serious geopolitical conflicts between some major powers. We haven't seen this situation, in my view, since the 1920s and 1930s.
Well, that's a marvelous summary there, Michael. You pulled together a number of the big themes and, added a general broad perspective. I just want to thank you for, quite a bit of work there. Could I ask, a number of us didn't get all the phrases, the words, the interpretation in an earlier period, and even in the next period, and even when you spoke recently, we could hear you, but there is some technical fault somewhere. It went up and down.
There is,
So,
I'm going to have to look at it. I have put the charts onto the chat if people want to take those.
Okay, fantastic. That's what I was going to ask.
Yeah.
So we look forward to seeing your blog or getting it from there. Okay.
Even if you can't hear me, next time I'll get ChatGPT to do it. That'll be very clear.
Yeah, that would be great. But look, what we'll do, we'll circulate, what we've got. We want to thank you, enormously for coming in again and for focusing on the specific banking issue linked up to the global issues. Ed, do I see an indication from you? No. Okay, sorry, I thought I saw a hand up there.
That was a clap. That was a clap for Michael.
Okay. Well, I think we can get quite a few more claps. Well done. Fantastic. Okay. Roger, would you like to come in?
Yes, please. Yes. I would ask comrades to stay. A couple of announcements I'd like to make. First of all, we have a series of wonderful meetings lined up over the next few weeks. We've got at least 6 of the future meetings arranged, but the order still needs to be sorted out. So I would ask comrades to please check your inbox and check your emails, and all the information for next week will be in your mailbox by Wednesday. But I'd also like to remind comrades, first of all, we've been running these meetings for over 3 years now, nearly every week. We've hardly missed a single week, and we've had, I think we've all learned enormously from it. I know that I have, for a start. And all of the past meetings are available to be watched online, the recordings on our YouTube channel. Just a reminder to comrades to check, including, by the way, previous excellent meetings addressed by Comrade Michael Roberts. Please also note the following. Our magazine, On the Brink, issue number 7, is out. It's been out for a couple of weeks now. It's available to anybody to read online, free of charge, or you can order a printed copy by post, and the payment details will be provided. Do please have a look at it, because a lot of work went into it, and I think it'll be useful for comrades in many ways. There's also a new pamphlet, especially relevant to British comrades, about the crisis in the Labour Party. It's called Labour's Coming Split. One other thing too, please note, I have mentioned it in previous emails, but we have a full WIN conference lined up in September. It will be a physical meeting in London with accommodation provided. and we would really welcome comrades to be physically present, but there is also the option of online participation. Please indicate if you would like more details and if you'd like to participate. It'll be on the weekend of the 9th and 10th of September. Okay, so thanks, comrades, and look forward to seeing you all next week.
Thanks, comrades.